Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at two strong buy tech stocks to consider adding to your portfolio for the second half of 2021. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. All right, so before we jump into these two strong buy stocks to consider for the second half of the year, I want to take a broader look at the market and some of the earnings pictures to give a better understanding of why we're taking a look at these two strong stocks, despite things sitting at new highs. So the S&P 500 jumped about 0.8% last Friday to hit its seventh consecutive record, which marked its longest streak since the late 1990s. The NASDAQ also jumped to new records, and the Dow hit its first closing high since early May, before the long 4th of July weekend. So the positivities end the week came on the back of a strong jobs report, which added 850,000 jobs created versus the expected 720,000, so a big beat. About 200,000 of those were waiter and bartender jobs, with about 345 in the broader leisure and hospitality space. This is part of that reopening effect as businesses come fully back into their working functional space and all of that. So there's no more capacity limitations at a lot of places pretty much throughout the United States. So the report created what many in Wall Street are calling sort of the Goldilocks scenario for the Fed, since unemployment edged slightly higher actually last month. So it went to 5.9% versus 5.8% as more people actually are entering where they're looking for work. So that's a sign of positivity, but also maybe not going to force the Fed to raise those rates as quickly, despite rising prices, which they're attributing to supply chain setbacks, pent-up demand, comparisons against those COVID lows, all of those things you've heard about for why the prices are going up, which also clearly makes sense. So let's also look at how stocks ended the second quarter and then some of the broader themes before we look ahead. So the NASDAQ has soared back to new highs to end the second quarter, with the technology-heavy index up over 12% since May 12th. This has seen Wall Street pretty much use every pullback and healthy recalibration in big tech as a chance to buy their favorite stocks, from Microsoft and Adobe and other huge titans to countless growth names at discounts. Wall Street has driven stocks to highs amid the low volume summer months, despite those inflation fears we just touched on. And the market has seemingly shrugged off the possibility of higher interest rates, and the yield on the 10-year U.S. Treasury note has actually slipped back below 1.5% from about 1.75% in late March. And as of Tuesday morning, so this morning, the 10-year U.S. Treasury yield was at about 1.37%, which signals that some of those overheating worries might be cooling down. And as of Tuesday morning, or mid-morning Tuesday, the NASDAQ was down about 0.3%. The S&P was down about 0.7%, and the Dow was down about 1% as they pull back from those highs last week, which makes sense as investors take some profits as they've been run up in the last couple of weeks leading into that 4th of July weekend and ending the second quarter. So meanwhile, the ability to look beyond those rising prices amid the booming U.S. economy could mean that Wall Street understands that there is no alternative investing, so that TINA investing won't really end anytime soon, with interest rates set to remain historically low, even when the Fed is forced in, even if they're not forced, even when they slowly start to lift their rates, maybe by 2023. This means investors will likely be left chasing returns in equities for the foreseeable future. The growth is, of course, supported by the resurgent U.S. economy and the impressive S&P 500 earnings picture that is expected to keep getting better. So I'm going to quickly just go over some data from parts of my boss and the director of research at Zacks, Shrazmian's earnings overview from last week. So he notes that the Q2 earnings picture for the S&P 500 is expected to climb about 62% at the moment above those the COVID hit tally achieved in the year ago period. And it's also important to note that Q2 earnings are supposed to be up about 10% above the comparable period in the pre-COVID period in 2019. So Q2 of 2019, we're supposed to be up from there. So that's not just the easy comparisons. We're showing real growth. And he quote says, "Given how strong earnings surprises turned out to be in the preceding reporting cycle, meaning the first quarter, the final earnings growth tally for the current quarter could be as high as 80%. So up from about 62 at the moment, we're calling for the S&P 500 earnings growth. It could be all the way up to 80. On the annual front, we're calling for about 36% earnings growth on about 10.7% top line growth and another 11.3% earnings growth and 6.5% growth in 2022. And then very similar figures in 2023 as well. And then he goes on to say, quote, please note the double-digit earnings growth expected in each of the next 2 years. This suggests that the market isn't looking for a one-off rebound this year, but rather an enduring growth cycle that continues over the next couple of years. So that's that positive overall earnings picture that is helping support the market climbing to new highs, despite some of, as we mentioned, these inflation fears and overheating fears as well. So all that said, some investors might be hesitant to buy stocks with the market at new highs, and there clearly are valid reasons for avoiding doing that. But timing the market is extremely difficult, and trying to do so can lead to the dreaded buying high and selling low, and also missing out on those comebacks, which we've seen on full display over the last 16 months or so. So if you sold as market was crashing during the COVID sell-off, and you sold and then you didn't buy back until midsummer, you already missed the huge rip higher. And we've seen all of that happen in the last year as well. As we mentioned, Wall Street is using every tech pullback and every market pullback as a chance to just buy their favorite stocks at a discount. So instead, longer-term investors with the horizons of about a year longer are often better suited by buying strong stocks and staying constantly exposed to the market, even during dips and corrections, which are healthy and common. So today we're diving into two stocks that are poised to grow in a world dominated by technology that might be worth buying as we start Q3 and head into the second half of 2021. And with that said, we're going to start with a stock that was a standout in the early pandemic period, and that is Zoom Video, which trades under the ticker ZM. So the remote work world brought on overnight by the pandemic thrust Zoom Video communications into the lives of everyday users, businesses, and Wall Street. And those unprecedented circumstances helped the company's revenue soar about 330% last year. So just a massive year for them. The standout growth stock then began to tumble in late October as investors dumped Zoom in anticipation of the economic reopening, which is currently underway. But the cloud-based video communications platform has diversified its offerings, and it's poised to thrive really in a world that's going to be more hybrid than ever. And Wall Street seems to agree that Zoom has legs beyond the pandemic, with the stock up around 35% since early May. So it's up over 35% since May 10th. So even though these family Zoom calls might be gone for good, or at least the mass amount of them are going to be over relatively, as more people are just heading back to their normal lives, and schools appear ready to restart fully in person in the fall. So amid that, you'd think, oh no, maybe that's not good for Zoom. But the end of the consumer level Zooming doesn't really impact Zoom, as they make money from their paying business clients that have really expanded in the last 16 months or so. So for instance, Zoom closed fiscal 2021, which was its period ended in January 31st. So last year, with around 467,000 customers that had more than 10 employees, which was up nearly 500% from the year before. And its customers contributing over $100,000 in trailing 12-month revenue surged 160%. Clearly, that is the past, and Zoom naysayers are focused on the return to a more normal working world, as big companies throughout the country slowly start to call some of their employees back to the office. But despite the eventual return to the office, the hybrid environment where people come in, say, 2 to 3 days a week, could possibly become the new normal, and many people in professional services jobs and jobs that require college degrees with more leverage that are done often almost completely on their computer, and have the ability sometimes to change jobs more easily, could find the remote work life more beneficial. And that might be something that they just is a must-have whenever they're looking for employment. So that could cause more companies to have these hybrid offerings going forward. So the massive climb in corporate earnings also, especially in the tech world, in the current US GDP growth, have all helped showcase that the work from anywhere world can be accompanied by economic expansion, as still many people are working from home throughout the United States, even as people return to more normal lives outside of their home. So Zoom also enables businesses to cut back on travel, which was a pitch it was making well before the pandemic. And the pandemic might have changed corporate travel environment for good with the help of Zoom and other video services. And certainly international business travel is going to be affected for a very long time going forward. Meanwhile, countless other jobs are done nearly, as we mentioned, all on computers driven by business software, cloud computing, that software as a service world, and companies of all shapes and sizes from every sector now rely heavily on various technologies. And there's really no going back. So most people's jobs are, no matter what industry you're done in many worlds, in many industries, are done pretty much all on the computer. So Zoom has expanded its portfolio from a video conferencing app to a more complete communication platform that includes Zoom Phone. So that's a cloud-based phone solution that are quickly becoming more popular as businesses look for modern telecom offerings. So the goal is to have a unified place for calls, videos, meetings, chat, and more. And the company also has Zoom Rooms, which are its updated take on the conference room, which is designed for that hybrid world we were talking about. So just a conference room that seems more, it facilitates people being in the office and working from home, just that new hybrid world. Zoom also announced in late May its new Zoom Events platform that, quote, combines the reliability and scalability of Zoom meetings, chat, and video webinars in one comprehensive solution for events, with the ability to produce ticketed live events for internal or external audiences of any size. So that's another expansion they're doing. And the changing environment is also a big reason why you saw a company such as Salesforce plan to buy Slack, which is a work-focused communication platform, for nearly $30 billion, which would be the second largest deal in software history. So now on some of the numbers, Zoom topped our first quarter FY 2022. So the period ended in April, the end of April, in early June, with its revenue up 191% to $956 million, and its adjusted earnings soared from 20 cents a share a year ago all the way up to $101.32 per share. Which also crushed our bottom line estimate. And then in terms of that customer growth, customers contributing 100K or more in trailing 12-month revenue, jumped 160% again to nearly 2,000. And then they closed the quarter with nearly 500,000 customers with more than 10 employees, which was also up 90% from the prior year quarter. Management also said on its earnings call that its cloud-based phone service reached 1.5 million seats, up from 1 million that the company reported in January. Zoom also raised its full-year guidance last quarter, and Zacks estimates now call for its fiscal 2022 revenue to jump another 50% from $2.65 billion all the way up to $3.99 billion. So basically from $2.7 billion all the way up to $4 billion. Clearly, this marks a slowdown from the impossible to recreate last year of that 330% expansion. But nonetheless, the ability to grow another 50% or add about $1.34 billion is highly impressive and shows the stability of its subscription model and the continued demand from business clients. The firm's 2023 sales are then projected to climb another 21% higher to reach about $4.8 billion. And when we note it pulled in just $623 million in all of FY20. So that's the year before the pandemic. So at the bottom end, its adjusted 2022 earnings are projected to surge another 40%. And that's after they skyrocketed by 850% last year. We've also seen its FY 2022 and FY 2023 consensus earnings estimates jump since its report. The recent climb is also part of a continued upward revision trend in the last year. So if we look back, Zoom went public in April of 2019, and it's climbed about 345% in the last 2 years. That said, as we mentioned, the stock has fallen back to earth since its huge early pandemic run, and it's up about 50% in the trailing 12 months to roughly match the broader Zacks tech sector. Luckily, the stock has mounted a comeback since it fell into oversold RSI territory of below 30 in early May, and it's benefited from the broader resurgence of tech stocks that's pushed the NASDAQ to new records. So ZM has climbed about 40% since May 10th, and it popped another 3.5% on Tuesday morning to over $400 per share. The recent pullback has it sitting right near overbought RSI levels, so there could be a near-term pullback for sure. But despite that climb, Zoom is still trading 25% below, over 25% below its October records, and at a nearly 60% discount to its own year-long highs at about 26.3 times forward 12-month sales, with it trading not too far above its all-time lows in terms of forward sales as well. So there's plenty of room to grow there. And on top of that, we should note that Zoom broke above its 200-day moving average last week, and this is after it climbed above its 50-day back in May. So this could create continued momentum. Overall, Zoom's positive earnings revisions help it grab a Zacks Rank #1 strong buy at the moment, alongside its A grade for growth in our style score system. And we should note that 7 of the 18 brokerage recommendations that Zacks has for the stock are currently strong buys, with none below a hold. So Wall Street is still pretty high on Zoom long term. Furthermore, Zoom boasts a solid balance sheet, and it bolstered its cash position through a secondary stock offering back in January. Zoom wanted to, quote, maintain what its CFO called optimal flexibility on its balance sheet, and it ended the first quarter with about $4.7 billion in cash and equivalents and no debt. So this should help the company continue to diversify its business and pursue new strategic growth areas down the road as it sees fit in this hybrid work environment. So Zoom Video, that's resurging back again, that's still trading well below its highs, certainly looks like a stock that might be worth considering, even if it has a near-term pullback, given how much it's run up since May. Now we're going to move on to another highly ranked Zacks stock that's in the broader tech world, and that is ServiceNow. It trades in the ticker NOW. So ServiceNow provides cloud-based services and solutions to nearly 7,000 enterprise customers, including about 80% of the Fortune 500. The company is a digital workflow firm that was added to the S&P 500 index back in November of 2019, and it's expanded its partnerships with the likes of Microsoft to help it sell to highly regulated industries and house its full SaaS offerings on Microsoft's popular cloud network. Now has also expanded its revenue by over 30% every year since it went public back in 2012, including 31% top-line growth last year. The company then topped our Q1 FY 2021 estimates at the end of April, with sales up once again 30%. The company closed the quarter with over 1,100 customers with more than $1 million in annual contract value, up over 23% from the year ago period. ServiceNow will also benefit from the constant wave of technological innovation that forces businesses, as we mentioned with Zoom, of all industries to continue to adapt and spend to keep up with just the fast-paced world we're living in. The company also announced in late March plans to acquire the robotic process automation firm Intelibot to help expand, quote, its core workflow capabilities to help customers automate repetitive tasks from intelligent end-to-end automation. Zacks estimates now call for its revenue to climb about 27% this year to about $5.7 billion, with FY 2022 set to jump another 25% higher to reach $7.2 billion. Meanwhile, its adjusted earnings are expected to jump about 19% and 28% respectively, and it now has consistently and easily topped our bottom line estimates, recently including a 16% average beat in the trailing 4 quarters. ServiceNow executives also said last quarter that they, quote, have a strong momentum on our way to becoming a $10 billion revenue company. And its stock price is certainly showing that Wall Street's pretty high on the stock. So now has skyrocketed over 700% in the past 5 years to blow away the Zacks tech sector's climb of about 200%. And luckily for those who might have missed out, its shares have cooled off, lagging its tech peers in 2021, up just about 1% so far this year. The stock tumbled after its Q1 report on the back of some lackluster guidance, but now is regaining momentum along with the broader tech sector in those growth stocks within that sector. And Goldman Sachs actually put it on its conviction buy list not too long ago, and ServiceNow sits about 7% below its February records at the moment, and it's hovering, just like with Zoom and much of the market, near overbought RSI levels. with it up over 20% in the last month. So like with Zoom and much of the market, we could see certainly a near-term pullback as stocks surged up to new highs to end the second quarter. But as we mentioned as well, longer-term investors shouldn't necessarily try to time the market and certainly not be afraid to buy at new highs, because if you're buying a stock you believe in, you hope it continues to hit new highs over and over and over again, year after year after year. Now currently lands like Zoom a Zacks Rank #1 strong buy, and Wall Street remains very high in the stock, with 17 of the 22 brokerage recommendations that Zacks has coming in at strong buys, with 2 more buys and none below a hold. So therefore, investors might want to consider now as a growth-focused software play that's prepared to benefit from that subscription model in the booming software as a service space, alongside the likes of Salesforce and countless other companies within this broader world, including Zoom. So both of these highly ranked Zacks tech stocks look worth considering as longer term investments at the moment. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.